live on YouTube, LinkedIn, Twitter, and in real life. So let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm once again joined with my good friend Doug Hagren. Hey, Doug.
Hey, Kirk, how you doing today? I'm excited, by the way. You know what today is? December 1st. Do you know what that's the start of?
Christmas?
What is the start of Christmas? For the next 25 days, it is Advent.
Shopping.
Advent. And guess what? I am a member of two very important Advent calendars that I pick up every year. One is the German beer Advent calendar, and the other is the whiskey Advent calendar. So today, I get to start 25 days of practically double fisting. But anyway.
How does that work, Doug? How do you get an Advent calendar with whiskey and one with beer? How do they make that?
How did they make that? So there's a company out of Germany. The company was actually the beer one's through Costco, and they come out with it every year. And it's a company that goes to German microbrews, and basically a big cardboard box and 25 days of popping it open and pulling out a nice big, 16-ounce German beer. All these local breweries, it's amazing. And then there's another one that just discovered this year that they're doing 25 days of little kind of 1 or 2 ounce bottles of different whiskeys around the world. I don't know what we're going to get into. I haven't done this one before. I think it's going to be scotches, bourbons. Hopefully, maybe it's Canadians. Hopefully we get a little Japanese whiskey in there for any of you connoisseurs out there. Japanese whiskey. Ooh, some of the best by far in the world. So anyway, it's time to celebrate. May we all be festive. So I actually sent Craig, my business partner, Craig, one of those Advent calendars too. So next 25 days, we get something to celebrate every day.
Well, now I know I fit in the hierarchy, Doug, because I didn't get one of those from you. So
not yet. You're working on it, Kirk. Craig and I have been partners since working together since what 2014. So a little more time here.
A little more time. Okay.
Yeah. All right. It took him almost a decade to earn it. So you're on pace.
I need a lesson in adulting. I didn't realize they had Advent calendars for adults. Like I just got some for my kids, or I didn't get some for my kids. Red, our elf, got some for our kids, even though that they totally don't believe in any of it.
So my wife and I kind of miscommunicated on this one. So my kids, we both went out and got Advent calendars for our kids. So now my kids are also double fisting the Advent calendar on chocolates, which is going to be wonderful, to have the house bouncing around. I do want to make a caveat, which I saw a statistic the other day. Speaking of adulting, we've talked about this before, Kirk, about the rising population of Japan and the impact that has on their economy. I saw something the other day that because of the declining youth population and baby population in Japan, they are just about to the point in which the sale of adult diapers is exceeding the sale of baby diapers.
That happened 10 years ago. The first time it happened was 10 years ago. Yeah, because it was a big deal. We actually wrote a blog post on this on the Japan demographics, and that was the first time. I think it was 2012 or 12 or 14, somewhere in there, was the first time that adult diapers exceeded baby diapers, which is interesting. And this isn't the point of the show this week, but it's an interesting fact that impacts everything, which is demographics, right? We look at this country and we got baby boomers retiring, a huge wave of people retiring, leaving the workforce. That's a demographic shift. Is it going to change? Is it going to crash the markets tomorrow? No. And all these newsletters talk about that. Oh my God, it's going to be in the world. Baby boomers are retiring over a 15-year period. I'm sure it's going to be okay. We'll adapt. Will it impact things? Absolutely. Right? Japan, huge problem. Europe, huge problem. China, not so much. Well, they were fine, and then they instituted their one-child policy, and now they actually got a real problem because now they got the problem that we have, which is they've got a generation of really big amount of populace. I forget what they call it, but you look at a Christmas tree and how it juts out and in and out and in. And some countries like Japan is one of them that has that. And there's some visuals, which I'll see if I can find one for the show, which show that. Which the problem is in this country, the baby boomers, huge generation, Gen X, like Doug and I, Gen X, small population. Then you get millennials, huge population because they're the kids of the baby boomers. And then the next one is smaller, and it doesn't stop because once you get that kind of that changeover, it's really hard to change the numbers. So really interesting stuff, though. So let's let's dive right in because we had a lot of updates come up recently, a lot of stuff in the news, and want to cover some of it. But one thing I did want to cover is really kind of the title of the show, which is it still Black Friday? I've found it fascinating this year. I'm always interested in just like being mindful of what's going on because you never really know the numbers until they actually come out later. But I'm always kind of mindful, like what's going on. Well, in past years, Black Friday, Cyber Monday, it's a big deal. This year, Black Friday started the Monday before Thanksgiving, and it's still Black Friday. I'm still getting emails of Black Friday sales. Like I'm pretty sure it's past Cyber Monday too, and they're still holding sales. And what's interesting is I think Amazon, which is one of the biggest retailers, if not the biggest at this point, not retailers, but retail shops, if you will, online. They have great numbers, obviously. And Walmart's another big one too. They have numbers which are indicative of what's going on. And so when you hear them come out and say, "Wow, we had great revenues," it's like, okay, how'd you get there? Like, because I saw a lot of deals, especially in the technology space and the information space, people were giving 70, 80% off. So there's tech that I buy, and it was like, hey, we're having 80% off. I'm like, I guess I can buy another year. So if you think about that, how many people bought a year in advance, and so they're sitting all this extra cash, which is great, but that means that they don't make cash next year, right? It's like a credit card. It's like, hey, I can spend on shoes today that I don't have money for because I'll pay it back over to the next year. But that means that I'm not buying shoes for the next year because I've already bought. Well, I've already bought them, but I don't know. My kid's a shoe fanatic, so I get he wants to buy shoes every week. But generally speaking, like, yeah, I bought my extra shoes. Like personally, if I go and I see a sale, like I'll buy like 5 pairs of shoes because my feet aren't growing anymore, and I'm not trendy. So I'm not buying out of trend, but not buying in trend. I'm buying like middle of the road, safe male attire that's always in favor and never in, never out. Like I could buy 5 sets and I don't have to buy them again, right? Because I just go through them and just get the next pair. And so when you do that with credit cards or with sales, especially technology, like these companies aren't going to make money for the next year. So what are they going to do? And so what's fascinating is thinking about the dynamics of how this is going to play out in the future revenues. Is I think you're going to see a lot of struggling over the next 90 days. I don't know how the holiday season is going to pan out. I know that a lot of people are struggling. They have a lot less money to buy stuff. I know my kids are getting to an age where they don't like. My son's like, I have 3 things on my list, and one of them's really expensive, and you guys don't want to buy it for me. So, like, I don't want anything. I'm like, whatever. I'll just give you some money. I don't care. Like, if that's what you really want, fine, spend on whatever you want. But ultimately, I think people are getting to a point where their ability to spend is getting curtailed significantly, which ultimately means that the retail economy is going to slow down. And it's not that, I mean, we're consumers as a nation. We're not going to stop spending, but we are going to spend less, not because we want to, but because we don't have a choice. If all my credit cards are maxed out and all my money is going to pay the 33% interest rates on my credit cards, I'm not going to be buying anything. So that's not today. Like we're starting to see signs of that. And Doug will talk about some of those statistics as well. Like we're just seeing signs of it, but it's going to get worse because all the prices of goods, we had this high inflation and it's slowed down, but the prices are still high. They're not coming down. And then you've got wages, which have come up a little bit, but not enough. And you have interest rates have gone through the roof. So if you're carrying any sort of balance, now all of a sudden you got to pay 33% interest. Just think about that. You have $1,000 on your credit card, right? Let's say you have $1,000 of balance on your credit card. How much of that do you have to pay each year? You have to pay $300 a year in interest. It used to be you're paying, $50 or whatever it is. Now you're paying $300, $350 a year in interest just to keep the balance to go not going into default. Forget spending on anything else. That's crazy. And there's tons of people out there who are in that boat and they just I'm just going to default and go into bankruptcy. Like it's not happening yet, but it's going to. You think of student loans. A lot of student loans, people are now allowed to file for bankruptcy to get rid of their student loans. Well, good for them. I think it was criminal that they didn't allow that before. I think it was beyond criminal, but now at least that's allowed, which is great. still people should be paying back their debts because you borrow money, you really should, or the economy doesn't function. But I get the problems. Like there's a small segment of population that just can't pay it back, and then they're done for the rest of their life, and that's not fair either. So that's why our system, our economic system, and I don't know who came up with this, but it was really brilliant. In the reason, there are many reasons, but one of the major reasons that our country works so well, and that we're such a bastion for capitalism, even though it's not really true capitalism, it's kind of crony capitalism. But taken at its core, capitalism, the reason it works so well, private property. Not every country has this, but when you have private property, people can buy stuff and they feel comfortable that it's mine. No one's going to take it away from me. I bought this house; it's mine. Or you have to pay your property taxes, but no one can take it away from you, right? Unless you don't pay your bills, right, and or whatever. But basically, it's yours, right? That's really important in a society. Another thing that's important is that as an economy, as a culture, we take a lot of risk, right? People, entrepreneurs, they take a risk. And the risk is they put up their money, they put up their reputation, and they could destroy their company. It could go to zero, and they lose their reputation and they lose their money. They're taking a risk on themselves, which I think is great. I think everybody should have that ability to do that. But the brilliance of capitalism, or at least in this country, is that we encourage that risk by saying, you know what, if you screw up and a company files for bankruptcy, that's okay. Within a period of time, it's going to go away. You can try again, right? All your credit, it goes through all the bankruptcies, foreclosures, whatever debt. If you default and all that stuff in 7 years, it all goes away. You can start fresh, right? That's a great thing about this country is that some countries, and I forget, my buddy went to live to Prague, went to live in Prague in a while, and he was telling me this story and how if you borrow money, you don't pay it back, they put you in prison until you can pay it back. Well, I don't know about you, but I'm not earning a lot of money while I'm in prison, so I don't know how you're going to pay that back in prison. But that's a system that does not encourage risk taking, right? Because if you take a risk and you fail, you're in jail. That's not an acceptable risk for taking a risk to grow a company. So generally speaking, this country encourages risk taking, and that risk taking has allowed us to grow this economy to the wonderful economy it is. Now, it's not perfect. I get that. That's not the point. But the point is that you look at all these tech companies. The reason that we're the entrepreneurial center of the world, and that all of the new tech and all the new inventions come out of the U.S. is because we encourage this risk taking. Now, some other countries, like there was a time where Japan wasn't great at innovation, but they were great at reinvention, or they're great at innovating existing inventions. Like they'll take the cars you're making, they'll make them better, right? And they'll make them more innovative. Like they were good at that, but not maybe creating from scratch. Like we were always great at creating from scratch because we encouraged that risk taking. So I think it's really important to recognize that as a part of the economy. And also, we talk about risk on the show a lot. We don't talk a lot about how it affects business owners. But it's important to recognize that, because if the economy is setting up right now so that I'm just drawing a blank on the word disencourages. I know it's probably not a word, but it's not encouraging risk taking, right? Because if we have high interest rates, I mean, you can't borrow money at a reasonable rate. You're borrowing money at double-digit returns, which is really hard to start a business. If people don't have money because the economy is in the crapper, people don't want to take risks because we're in a recession. All these different things that kind of negative reinforcement loop of starting a business, it means people aren't going to start businesses, which is going to slow down the economy overall. Because you have this cycle, right? Business creation to business destruction or sell off or whatever it is. But you got this arc that businesses go through. And if you're not encouraging the behavior at the beginning, it means you're not getting the rest through the rest of the cycle. And that's a problem. And so we need to be mindful of the fact that a lot of businesses failed in COVID. A lot of businesses have started since. And whatever happens, we need to make sure that there is some encouragement of that business cycle. So before we get into the charts, anything you want to say, Doug, before we dive in?
Yeah, no, I think we do, and of course you were thinking of discourages and disincentivizes, right?
Yes,
But
that's what I meant to say.
yes,
I totally meant to say that. Doug.
yeah. I mean, no, we don't have debtors prison, and I think that's what you're talking about. And ultimately, we're probably the only country in the world that I can think of that has actually got a foundation of too big to fail, right? And we've seen that where, and we talked about this last week, where there is a lack of tolerance of feeling pain by our society, by our government, and at the end of the day, there's been a lot of attempt to step up and to bail out of those critical situations. But it doesn't, and so all of those little triggers that are been put in place have allowed this economy to thrive well beyond the economy, economical um, headwinds that would be faced in many other areas. And again, you're right. If you're going to be discouraged from taking risk, if you're going to go to prison, we have some of those issues here. They've talked about, in criminal proceedings, a lot of times that they impose these fines that are significantly burdensome on the people that are most likely to commit the crimes, that have the least ability to pay those fines in the first place, and therefore, it makes it very, very difficult for, once they are, opposed to court crime, to be able to get out of that cycle, and then of course that puts them back into prison. But and so we do have some of those things in place that are similar to that, but it has never been tied to the decisions around taking risk economically. And because of that, anybody, and I'm looking at the screen, looking through to anybody that's listening to this anywhere. I have said this before, on other platforms, and even in this platform. If you have an issue with those policies that allow corporations to thrive, if you have an issue with policies that allow corporations to get tax incentives that they say, are not being given to the average person, guess what? Go out and buy the stock, because that tax incentive, that bailout, that ability for corporations and individuals of any level to go out and take that risk, and it will be easier for some than others. But I just saw something today where somebody who had very little was able to build a resort of 100 acres in southeast Ohio. Again, the ability to go out and be able to accomplish that is open to everybody. Okay. And that is absolutely not the case in in anywhere, in most places throughout the world. Not only are there going to be the pitfalls like debtor's prison, but just the things like caste systems, that where you're born into is where you will forever be. Thankfully, we do have a financial caste system here, but anybody can elevate out of that caste system into another by taking the risks and having the rewards of financial success.
Yeah. So I want to I want to talk about a topic, and then we're going to dive into some of the charts again. So I wanted to talk a little bit about this. We talked last time about the forgotten lessons of 2008 from Seth Klarman. And I want to kind of reiterate each of these lessons each week, because I think that each one of them will we'll rehash some of the problems because we forgot, because they haven't happened in whatever it is, 14 years. And so it makes sense to kind of review those to make sure they're fresh in our heads. Because if we do go into recession next year, which a lot of people are predicting, it's hard to predict a recession at this point. Although all the signs I'm seeing predict right around May, it should, give or take a little bit, should be right around when we start to see it. So you should be prepared for that. Whether it happens or not is irrelevant. You should always be prepared. But here, let's talk about the second lesson, because it brings up a big point. So when excesses such as lax lending standards become widespread and persist for some time, people are lulled into a false sense of security, creating an even more dangerous situation. In some cases, excesses migrate beyond regional and national borders, raising the ante for investors and governments. These excesses will eventually end, triggering a crisis, at least in proportion to the degree of the excesses. Correlations between asset classes may become surprisingly high when leverage rapidly unwinds. Okay, let me break this apart, because there's actually a few lessons here. So first of all, we remember, most people who were around then remember the banking crisis of 2008. Lax lending standards become widespread and persist for some time. Yeah, they were terrible ninja loans. I mean, it was awful. It was the Big Short movie was based around this. Nobody knew where nobody knew where the excesses were, which is part of it. You know, it kind of gets into beyond national borders. You had countries like Iceland buying crappy debt. I mean, it was ridiculous. The whole world imploded because everyone just assumed that risk didn't matter anymore because the U.S. was able to sell their bank slash real estate related debt around the world, and everyone got harmed by it. So, that's a good example of a global crisis because everyone just assumed that real estate always goes up. Now, eventually it ends, as it did, triggered a crisis to the degree of its excesses. Well, those excesses were massive. However, when you think about it, the excesses that we have now are even bigger, right? So if you look at the housing market, you look at, well, I guess back then it wasn't corporate debt, but basically the housing market, right, which is pretty large, right? But now we're talking about sovereign debt crisis. We're talking about corporate bond crisis, high yield bond crisis. We're talking about the fixed income market, which has gone from close to 0% up to 5 or 8%, depending on which market we're talking about. And that's a big shift, and it happened so quickly, which creates problems, as we saw in March for Silicon Valley Bank and First Republic, and we've got a few other banks. One other very large bank in particular. I'm going to share a chart in a minute, and I'm not going to name it because I don't want to be the perpetrator of a bank run, but basically you can figure it out for yourself just by looking at it. So I'm just going to share it while I'm talking. So if you look at some of these challenges that banks had, now I don't think banks have the same problem that they had for effectively for the real estate crisis in 2008. That was a very different kind of crisis. Banks now, some banks, not all of them, some banks have a bigger problem right now, which has to do with, oddly enough, the core of what they do. So, lending money out to on real estate is core to what they do. And obviously some banks did it well and some banks didn't. But core to risk management of a bank, this isn't some sort of esoteric product. This is literally the core of what they do. They take in assets in the short term and they pay a certain amount in the short term and then they lend it out long term. So they'll take your $1,000, they'll take your $100,000 at, they'll give you 1%, right? So they give you $1,000 a year, and then they'll go take that 100,000 that you gave them, and they'll go buy a 2% 10-year bond, right? So they'll basically make $1,000 spread on that difference. Now, all else being equal, if everything's normal, that's fine. They make money that way. The problem is when they give you 0% on your money, and at the same time they're lending it out, or they're buying securities in the neighborhood of 1%, and now those securities are trading at 5%, and you're still giving them 0% interest. At some point in time, people wake up and say, I'm getting 0% on my bank money. I can get 5.5% in treasuries or money markets. I'm going to pull all my cash out and put it into treasuries or money market. Well, what happens? Well, now this bank that's made this terrible decision has to sell the securities that were at 2% and now they're at 5%, means they lost a huge chunk of money, let's say 33% of the money. So instead of 100,000, now they've only got 66,000, but they still have to give back 100,000. So what they do is they say, all right, we're going to give you back your 100,000, but now we can't sell 100,000 of their securities. We have to sell 100 and whatever it is, 130, 150, right? 100, yeah. So you have to sell 150,000 of securities, right? Because we're going to lose money on that, which means we'll have 100,000 to give out. So basically, you'll lose 50,000, right? So that is one example of what has to happen if people start pulling their money out. So these banks, one in particular, which is very high in the list, is in a very precarious position, where they've got the largest, one of the largest positions, portion of their securities. HTM Securities, by the way, is held to maturity. It kind of encompasses this, but basically they're buying long dated treasuries, and they have to sit on these things. So they have to sell them at a loss if people pull their money out. They don't want to do this, but at some point they might have to. So if people start pulling their money out, it's going to be a problem. And this isn't just this one bank. All banks have the same problem. But if you look in the rest of the list, there are some banks which are perfectly fine, right? There are some banks, one in particular, Zion's, which increased their held to maturity securities 1,651.6%. Now I look at that and say, what the heck is that? Well, here's a bank that's smart, okay? Because what they did was they just exponentially grew their portfolio at a time when they're getting 5% on the long date. So they're smart. They decided, hey, we're going to hang out in the short end. We won't make as much money, but now that's on the long end, now we can make a ton of money because it's at 5% and we're going to be okay. This is the exact opposite of what Janet Yellen did when she was in charge. She, instead of borrowing money in the 30-year rate at 1.5%, she decided to borrow at the short end. And now we've got, I don't know, 40, 50% of our treasuries coming due in the next 12 months. And we're up the creek without a paddle. So the banks are in a very precarious position. So when you think about the excesses, and this one bank in particular is one of, if not the largest bank out there, and that's a problem, right? Now, it's not, as you look at this list, it's not all banks, right? I want to be very clear. Not all banks have a problem. So it's not going to be a systemic problem in the banking sector. There will be a handful of banks which will have problems, probably in the regional side, maybe 1 to 3 banks on the larger side, but on the regional side, it'll be less of a problem. There might be some here and there. The big problem is going to be in sovereign debt. Is how's that going to work? Right? We talked about in the show and how China is selling they're not renewing their U.S. debt securities. They might be just letting them roll off. What this comes down to is the concept, and this is where I want to get to, the concept of moral hazard. Okay. Now, the one last piece before I get into that, which Seth had mentioned, was correlations become asset classes between asset classes become surprisingly high, which means 2008 is a good example. If you remember 2008, virtually everything was down 38.5% within a few percentage points. Everything. I mean, gold, bonds, stock, everything was down, right? And which is odd because that shouldn't happen. Well, 2022, that happened again. Everything was down, right? Virtually. I think it might have been 1 or 2 things up, but virtually everything had dropped. So there was no safe haven. So what he was talking about in correlations become surprisingly high. A high correlation means that when it's correlated to each other, it means you're getting the same return. You could have stocks and bonds, but you're going to get the same return regardless if you divvy it up between multiple ones. And that's the point, is when you get into crisis mode, which we've had and we will have again in the future, when you get into crisis mode, diversification is not going to save you. If anything, it's going to cause you more anxiety because you're thinking you're safe and you're not. So, and if bond yields start to climb, it's even less safe. So just be aware that diversification is not going to save you necessarily because most people don't diversify properly. So even if you're diversified, international, gold, whatever you want to be in, you're not necessarily safe. So just be aware that there'll be high correlation. But I want to get into this concept of moral hazard. Now, moral hazard effectively is, to kind of read the definition just because it'll just explain it better than me. In economics, a moral hazard is a situation where an economic actor has incentive to increase its exposure to risk because it does not bear the full cost of that risk. So, for example, Wall Street, investment banks, and big banks, whatever, any sort of financial institution, in 2008, many of them, if not most of them, should have gone bankrupt because they did not accurately assess their own risks. So all the financial institutions that got merged into other financial institutions for their safety, they were effectively bankrupt, and the government didn't want there to be a run on all of the institutions, so they forced merged them. Lehman, J.P. Morgan acquired like a bunch of these firms. Bear Stearns, a bunch of these firms got acquired by a bigger, more solvent institution. And what happens is if you look back, like AIG is a good example. AIG was AAA rated. It's one of 5 companies at the time that was AAA rated, which means they almost never go bankrupt. But this one effectively did. If you kind of let it play out normally, it was insolvent. And so what happens is you've got a company like that's effectively insolvent. Nobody should have got their money. Everyone should have not been able. They should have been fired. No bonuses. But what happens at financial institutions? Well, we got to pay them our bonus, or else they're going to leave, and we're not going to be able to attract talent. Okay, well, maybe the company shouldn't exist to begin with. Maybe you should just let that happen, right? Let them merge into some other company and let that be. They shouldn't get bonused for what? Bad behavior? But that happened all throughout the financial sector, and the public got squirrely about it. The public wasn't happy because, well, we had this bailout money. And it's going to basically bonuses from people that screwed up the company. Now I get both sides, right? And I don't want to be a two-handed economist here, but I get both sides. If somebody screws up, they shouldn't get paid. Flat out shouldn't get paid. But if you got a company that's under receivership, so to speak, and is being run with some oversight from some heavy-handed people, and they say, well, we got to keep the lights on, we got to keep people here, but you can't keep people here because the whole financial industry is based on bonuses, right? So if you don't give bonuses, you're not going to work there, and many times your bonus is multiple X of what you're earning in your salary. So if you don't give bonuses, you can't attract anybody. That's just how the industry is constructed. And maybe it shouldn't be, but it is. So let's not talk about what should be, because it is. So if you're looking at this and you're thinking, well, how do we fix this? Frankly, I don't know. The government, the economy, our culture has supported this. So now, if I know that I can take a risk, and the worst thing that's going to happen is I don't lose any of my money personally, but the company goes bankrupt and I'll just get a job somewhere else. That's the worst thing that could happen. The best thing that could happen is I could make tens of millions of dollars. Let's go all in. Hey, let's all let it ride and let's see what happens. That's what happens in the financial industry. And it's been happening for decades, and it's going to continue to happen. I actually had a solution to this. I wrote a paper on this, and a handful of people read it, and some major publications poo-pooed it, but I don't think they really understood it. And if you're thinking about moral hazard, right, you cannot reward that kind of behavior, and it's hard to not reward it. But if you think about why this started to happen, here's why it happened. Back in, I think it was the 80s, early 90s, when effectively prior to this, all of the investment banks or big brokerage houses were private partnerships, which means that all of the partners had a personal liability to the firm. So if you're a partner and you're worth $100 million and the firm goes bankrupt, the firm and debtors can go and get your personal money that is not attached to the business. So I could go from 100 million to zero, even though the 100 million is tied up in real estate, my house, and the bank account. They can claw all that back because as a partner, you're liable. And so that prevented these big investment houses, these investment banks, from taking huge risks because they knew they were personally liable. So if somebody wanted to take a huge risk, they say, you know what? Nah, we're not going to do that. That's too much of a risk. We'll downsize that, or we'll do something else. But we're not going. It's too big of a risk for the firm. I don't want to lose my money as a partner. That kept things in check because people were on the hook for bad decisions. Now, what's happened is those financial institutions have gone public, which means they have no personal liability for screw-ups. You think about it. Goldman Sachs effectively got bailed out. They were on the hook just like everybody else, and I'm not going to pull them out, but just because they're seen as the best of breed in financial institutions, but yet they were still in the same boat as everybody else. And so there weren't many firms that were safe back in 2008, but they got bailed out, as did many other firms. And so what happened with them in the late 90s is they went public. And now all the partners, they got paid because they got paid for their shares, but now they have no liability. So let's just take risk. Let's take as much risk as we can. Let's keep growing the machine. That's why the financial industry is screwed up, and it's only going to be cleaned up if we go back to that private partnership model where people are liable for their decisions. And that means that they will make good decisions because they know that they're on the hook. Silicon Valley Bank, they effectively had risk takers, risk mitigators, or risk officers that were supposed to protect against this. The one core purpose of a risk officer is to protect against stupid risk. And they weren't doing their job. We made fun of them on the show. We even pulled out some names. But these people,
Amongst sitting on the Federal Reserve Board and being in those meetings, listening to exactly what was going to come 6 months later in the interest rates. But I digress.
Exactly. So anyway, I'm going to wrap up and give Doug a shot here. So, but the point is that is a really important element to understand is moral hazard. And when we encourage that in our system and we reward it, it means we get more of it. And that's the whole point of moral hazard is you create a system that rewards bad behavior. So then I take a lot of risk and I do something stupid, but then I get bailed out. So next time I'm going to take more risk because, hey, I'm getting bailed out. Let's do 10 times as much this time. Next time, let's do 100 times. Let's keep going because we'll keep getting bailed out. And the government's like, I don't understand why this keeps happening. I wonder. Maybe it's incentives. So if you really want to know the answer to most of our cultural problems, look at human incentives. Most people, they try to solve problems with what they think is the best response. The Democrats have this in one place, the Republicans have it in another way. So they both have their version of this. But the reality is we look at it, we're like, this is a problem. We need to solve it. And here's how we're going to solve it. Does it line up with human incentives and behavior? If it doesn't, it's a bad solution because it'll never stick. It just won't, right? You can't say, well, human beings typically do this. It's like saying, well, you need to bail out the bankers. Well, their job is to make money. You can't yell at them for making money, making a profit. That's their job. That's their entire job is making a profit off of other people's money. You can't say, well, bankers are the problem. They're not the problem. They're just a job in the economy. The problem is systemic. It goes beyond the bankers. It's all of us, right? And it's what we allow. So just be aware of the moral hazard problem because if we go into recession, we're going to start to see it rear its ugly head again. And you're going to start to see things come into the forefront. And the big automakers that got bailed out, which still to me, I just shake my head at the travesty of Obama destroying contract law by giving these institutions to the unions, which I get, as a politician, I get why he did it. But it's like, they should have given the whole company the unions. Let them figure it out themselves, right? They'll figure out capitalism pretty quick. But I think we have to understand that this is going to come. And so as an investor, here's the takeaway. I'm going to give it to Doug. The takeaway is, as an investor, you have to realize that this exists. And you have to think about, do I want to be on the other end of owning an automaker that gets bailed out and all the equity and all the debt and the preferreds is given to the unions instead of me, the rightful shareholder or owner of the debt, and I'm just going to give it all to them? Do I want to be on the other side of that, or do I want to be sitting on the sidelines waiting for that to happen and then jump in? Because the best investment you could have made in the automakers was actually after the bailout, because there was no risk. They took all the debt away, so there's no risk. So everyone was bidding up the price of the stocks, of the debt. It was great because they'd taken all the risk away. But you want to be on the other side of that, not now. So just I'm picking on the automakers, but because of 2008. But the risk is everywhere. It's not the automakers. So Doug, thoughts on moral hazard? What do you want to discuss here?
I mean, you've said it all on that aspect. I mean, it makes me think. I just got finished. Watching the show on Netflix. The name's not coming to me, about the opioid crisis and the Sacklers. We've seen the same thing in so many different areas. I mean, basically here is they took a huge risk. They made billions of dollars on what would they get? They're bankrupt, right? But the family still got billions of dollars. It was totally worth it. Painkiller. Thank you. At the end of the day, too, if you go back to 2008, you talked about how these partners used to have a personal stake in the outcome. The other thing that they also used to do is have a separation of investment banking and retail banking. And guess what? Once they relaxed on some of those regulations, I think we've talked about this before. I know we talked about it before. I don't have this in front of me, but it was only a matter of 5 years later that we had our first massive bank crisis, because once again, they were given all the opportunity to be able to go out and be greedy without any of the personal stake and the lack. And listen, I'll say it. I am a cautious. I am cautious when it comes to regulation, right? There are certain times that regulation just makes sense. I'm not a fan of intense regulation. FAA is nice. When I'm at 30,000 feet in the air, it's nice to know that somebody's paying attention to safety. I don't know. Might just be me, right? So there are places in which regulation makes sense. We had lots more issues with air disasters after they deregulated, and lots of other issues that came from that. They've cleaned some of that up. But once again, this is something that, it's deja vu all over again, right? We're going to continue to see these types of things. And that's why you have to be able to take precaution, and you have to prepare, and you have to kind of see through that haze to recognize that, once again, when things start to become too heated, too escalated, that there's just too much easy money being made. Eventually that's probably going to be some level of moral hazard that is being ignored in that equation, and you're going to have to be cautious, take care of yourself. And that's why we always talk about manage risk. It's always there, but eventually we don't know when, but when it does occur, you have to ask yourself, have you prepared yourself for that moment?
Cool. All right, so let's dive into some charts here, and we'll with a lot of interesting stuff. So Doug was nice enough to send me a bunch of charts this week. He's been on a roll, so I'm going to get to some of those. I do want to touch on one, and we'll just kind of go back and forth here. So this one I find to be interesting. It is the chart on the VIX. And for those of you who...
I was hoping you'd go there.
Yeah, I'll start there, and I'll let you do some of the other ones. So the VIX is a fascinating tool for understanding what's going on. Now, technically, you can invest in like options on the VIX. The VIX is basically a derivative. So if you're buying options on the VIX, you're basically buying a derivative of a derivative, which is never a good thing when you think about the financial crisis in 2008. But think of it this way. It's a good marker for a tool. Now, look at this. So 2020, it reached a high of 85. This was, I think, the highest point. It either mirrored the highest point or was the highest point. I think the highest point prior to that was 80, but anyway, it was right around there. And that was in the whole world shut down globally. So yes, as a volatility index, I think that was great. Subsequently, things have come down a lot. Now, if you look at it, what you should note is relative to other things, where is it trading? Because in the past, and this is actually, if you go back a few decades, I think the low is maybe in the 6s or 7s. It was a lot lower. But recently, it's right around, I think, 12, 12 and a half, 12.69. So that's relatively low. Anything below 30, I think you're good. People are generally feeling good. Over 30, people are feeling very skittish. So I think as a trend, you've noticed that things have trended down, then they started to trend up in 2022, and then they've trended down this year. And so what you should take away from this is it's probably not going to get much lower than this, but it certainly can get higher. And I bring this up because this gets into my thesis of, the rest of this year, we could very well see the stock market bump up in this next month, because it typically does, maybe even in January, because January also tends to be a strong month. But in general, I would look at this as an opportunity to take profits off the table, free up cash, and just sit on the sidelines, get your 5.5% virtually risk-free treasuries while we wait, and just wait, right? Oh God, I wish I had that extra 10% return off that tech stock. We could always say we wish that, but I think we all wish that we weren't in the market in 2022 when the market crashed too, right? So you got to think about things holistically. Like, is this a good time to be invested, or is this time to get out? Well, if in this month, it appears this month's going to be a strong month, so there's nothing wrong with making a little profit while you can in this month, but just be very aware. You got to be nimble and be aware to take profits off the table, because no one really says this, but it's very interesting that at the end of the quarter or the end of the month are really good times where the market tends to turn. So January 2nd, December 31st is a good turning point. 2022, perfect example. Everything was fine in 2021. January 2nd or 3rd, whatever the first day was, all of a sudden it was a disaster and just kept going down for the whole quarter. What happened? Oh, what happened on January 3rd? Nothing happened. It was because the end of the year, people had a certain portfolio image they had to portray, and then they had to sell out because they wanted to get out before the bonds. To me, it's nonsensical, but that's how the markets work. So just understand there are turning points, and we are coming up to a turning point in the next month where people might say, you know what, now's a good time to do year-end tax loss selling, year-end tax loss gains. Although most people, if you got gains, you push them off another month into January. But if you're doing that management, then now's a good time to think about how can you shuffle around your portfolio advantageously. Like look at crypto last year. The best time to buy crypto is December 31st because it just shot to the moon after that, and it was beaten up. It was down like 70 some odd percent in 2022. So just understand that there are some turning points that you should be mindful of, and those turning points can help you increase your portfolio returns. And the VIX is a good indicator of that. Doug?
Yeah, and again, not to give predictions on the VIX, but and so I'm not going to throw any specific numbers down here. And if you want to go back and do your own research, feel free. But there tends to be a pretty solid pattern on the VIX historically of when it hits certain levels, the markets tend to reverse, okay, and go the other direction. And it can give you some sort of an indication of kind of when to take some caution or when to be opportunistic. And it has shown a pretty good pattern there. I caution using any type of VIX instrument out there. I'm not going to get into the details of understanding what contango is. But ultimately, because of the fact that you're dealing with futures, just holding on to something that, to an instrument that deals with contango, you could lose money just by nothing happening. So, and actually declining a value as those futures reset. So I know some people will try to trade the VIX out there and trying to use this volatility. Listen, it's an extremely dangerous game to do that. So don't, don't, if you're going to use those instruments, let someone who's an expert in those instruments use them. But the VIX can tell you a lot of information around sentiment, and it can tell you a lot of information around where apathy is happening or over exuberance is happening in the market. That, again, when we talk about, as one of many metrics, it may be one of those tools that you can use to determine a little bit of when to maybe take more risk or go risk off. You talked about before, I want to jump to another one. You talked about earlier on this conversation, just the strain that we have talked about on the impact of household finances. Again, some of this might, in the wearing down and Black Friday, Black Friday deals. Although I thought it was really interesting, there are some Black Friday deals, though, that people have shown by walking around stores. Look at the Black Friday sale, and then they pull the sign out, and it's the same as the sale that was there before Black Friday. A lot of marketing around that, but there are true deals that are going on out there that have been continued. I think there is a lot of money that is, I think it's a couple of things. They're, these companies are trying to get what money they can in right now, and it's kind of like the federal government's gambling with Roth conversions, Kirk. The federal government saw that, it looks at your 401ks and your IRAs every day and calculates the money. And I'm going to come back to that chart, but calculates the money that people have that they're deferring. They make, well, I don't know if they make any financial decisions anymore, Kirk, but historically they have looked at trying to make long-term financial tax decisions around that revenue that's being deferred or postponed. Well, by changing the rules and allowing Roth conversions that used to not be allowed to anybody over $100,000 in adjusted gross income, it created a wave of people that were able to make Roth conversions that hadn't previously been able to do that. Well, guess what? That's an incredible jolt to the federal government in terms of taxes, because now all of these people could do these conversions and pay an immediate amount of taxes on those. But here's the catch. That money is now flushed out of the system that used to be deferred as a future tax revenue source for our federal government that in many cases has been significantly diminished. And I think that goes back to the Black Friday conversation. These companies are betting on taking a lot of money in right now. But what does that mean in terms of revenues in the future? And why are we worried? Why is this a compounding concern? Well, as you can see on screen right now, households are getting squeezed. Okay. You talk about, everyday expenses like we talked about auto insurance and home insurance. And, depending on what state you're in, Florida has seen an 88% increase in automotive insurance. We talk, offline, Kirk and I were talking with some other individuals about the impact of what an impact to a Tesla is, right? Because the expense of these batteries in these cars. Now, anytime that they get even a minor collision, it could be completely totaled. And that amongst, theft and other reasonings are resulting in extreme spike and more in some areas. I'm in Minnesota. Rates, I think on the chart I saw, only went up by about 4%, thankfully. So I haven't been able to feel that. I think, Kirk, where you're at, rates have gone up about 14% on the East Coast, but 88%, 40%. This is a massive shift, to the budget, because this is something you legally have to pay for if you're going to be driving. What does that mean? More people are going to be driving uninsured, possibly? There's always going to be a fallout. Now you look at credit card debt hitting new highs. Again, people have taken on more, continued to do spending. They've run out of that M2 money supply that's there. So now they're going on credit. And this credit is also being subjected to increasing interest rates. You talked about, Kirk, I think last time, even with a high credit rating, maybe seeing 15, 20% interest rates. For people that don't have a good credit rating, you might be talking 25 to 30% interest rates. There's some charts on that. Historically, credit card minimum balances requirements on monthly payments have been around 2%. Okay. The problem is when interest rates get up to 20 to 30%, you can't do a 2% minimum and cover the cost of interest. So now the minimums, which they may have shifted that minimum, how much was covering interest rate versus how much was going to principal, it shifted. More money going to interest, less money going to principal. There was already an issue getting out of credit card debt before because minimum payments they're not amortized. They don't put money towards paying down that principal. Now the problem is as interest rates have gone up, the minimum historic calculation of, say, 2% of the balance per year divided by months no longer covers the interest. So now people who have taken on a greater amount of balance are not only seeing that, that it's not just 2% of the balance, it's more than that. And it's all going to interest. We just passed $1 trillion in credit card balances. And again, this doesn't go away unless you have one of three things happen. You pay it down, bankruptcy, or other types of loan forgiveness, or you get some windfall from Uncle Fester that comes in. And guess what? There's a lot of people I think are living off that type of hope. If you go back to the other chart that you had up, Kirk, I think was the personal spending cooling. Okay. This, again, as long as people have cash flow, they're going to feel that they can get by to next month. But here's the issue. Here's the domino effect. U.S. personal spending cools. Where does spending go, Kirk? It goes to the corporations that charge for things. And generally, it's going to be goods and services because you can't not spend on your heating bill. You can't not spend on your auto insurance within, of course, legal parameters. So this means that it's going to start to affect the economy. Those companies are paying people to do those jobs. Those people are the people that are again spending less. So if you're spending less to companies, they're paying people. Now those companies are going to start doing layoffs. And those companies start doing layoffs, that's even less money to spend. And if those people already have high credit cards, and if those people already have high student loans. And if those people are part of the people that took on, these exceptional mortgage rates, which of course we can get back into. I know we're running out of time, but there's now it's again, how much to rent versus how much to buy and what makes sense there. And a lot of people took on a lot of mortgage debt over the last 2 to 3 years. And some of this was at lower interest rates, but a lot of it was also at the new higher interest rates. Now, all of a sudden, it's all good as long as cash flow comes in. And as I've said before, the number one cause of financial stress is lack of access to capital. You don't pay for things. Whoever you work for is paying for things. You get the money, it goes through your fingers, you can funnels out the door. When that stops and you now become responsible for paying for those things, and it is only from what you already have, that's when the domino effect occurs. Because how do you pay those credit card bills? How do you pay that auto payment? How do you pay that insurance? And eventually, and I know there's a lot of pundits out there that say real estate is one of those things everybody wants and needs. Eventually, there's going to be a question on how do you pay for housing. And a lot of people equate this, Kirk, housing to mortgage payment, right? Well, they don't have any mortgage payment. But we've talked about some people are all of a sudden, if they have a mortgage payment or not, are seeing a $900 per month increase just to cover a home insurance, just to cover property taxes. That's real effect on cash flow. And eventually, when it all compounds, you will potentially, let's say guarantee, but you will potentially start to see some people who already have paid off their mortgage be in a position of having to consider selling because they can't afford to stay where they are. Housing is more than just a mortgage payment. I think it's really important for people to understand that.
Yeah, that's important. And I'm going to touch on one chart before we wrap it up here. So I wanted to point this out because I see this kind of stuff a lot. And I think it's really important to kind of show the difference between causation and correlation. And so looking at this chart, and those of you who are listening, I'm just going to explain it to you. This is a combination. It shows the federal funds effective rate, basically the Fed funds rate, and then it shows the stock market overlaid above. And what they're trying to show is that every time the Fed pivots, meaning going from raising rates to dropping rate, right? Every time that pivot happens, it causes the stock market to crash, right? The majority of the stock of the decline in bear markets occurred after the Fed's pivot is the wording. Now, I see this stuff a lot, and I want to point this out because it's so important that we all get manipulated by this. And until you really see it, once you see it, you won't be able to unsee it. And that's why I'm trying to educate everybody here. So you look back since the 60s, it says, all right, 1969, the Fed pivots, meaning they went from raising rates to lowering rates, and then the stock market dropped 36%. 73 dropped 48%, 27% in 81, 51% in 2000. 2007, 58%. In 2019, 35%. Now, if I'm looking at this, right, let's just take this on its face value. Wow, it says every time the Fed decides to lower rates, the stock market is going to crash. So the Fed shouldn't be lowering rates. Like, that's the conclusion you're supposed to draw from that? It's ridiculous. How about a different conclusion, which they don't show, which is the Fed was raising rates, which caused the recession, right? Because anytime you're raising rates, it's basically trying to shrink the economy, through the lifeblood of the economy, which is debt and credit and all those things. So you're trying to shrink the economy, right? So raising rates does that. It slows down the economy, as Powell calls it, demand destruction. But basically, you're pushing the economy into recession. So you're raising rates to do that, right? And slow down inflation, which was a big part of this, right? In the early 80s, late 70s, it was about slowing down inflation. That's why they raised it so much, which also should cause a recession, right? Because if I'm a business and I'm borrowing at 5% and I got to borrow at 20%, well, I can't borrow at 20, which means I can't use that money and I can't expand. Thus, the economy shrinks or doesn't expand. So when people talk about like, well, as soon as the Fed pivots, that's when the recession is going to happen. I disagree. I think that the recession happens because of the raising of rates. And then sometime after that, 6 months to 2 years, depends on the recession. Sometime after that, that is when the recession happens. And the Fed sees these signs and they say, all right, we need to start lowering rates. Like think of 2000, right? I remember 2000, and I remember that everyone knew it was like a bubble. Like there was no question that it was a bubble. And the Fed kept raising rates. And people were like, what are you doing, Greenspan? Why are you raising rates? That's ridiculous. You're trying to slow down the party. And then, Abby Joseph Cohen, uh, at the end of the year, broke the gavel. She was gaveling. She broke the gavel as if that wasn't a sign. There were signs everywhere, right? And I'm just saying this in tongue in cheek because we all notice the signs after, but not before, because they're not really signs. They're just coincidences. But if you're looking at this and you're saying, hey, 2000 was an example. Okay, well, I think it was kind of obvious it was a turning point, and we had 4 months really to get out, from January to April before we really started to go down. But if you thought it was a bubble, and then the Fed realized at some point, hey, things are starting to cool. We better lower rates, and they lowered rates really quickly. One time, I forget when, they even lowered between meetings. I don't know if this is the first time it ever happened, but it wasn't at a traditional meeting. They just decided to lower rates just out of the blue. Because they felt like, I don't want to wait, I want to do it now. And so they dropped rates really low down to whatever, close to zero, relatively quickly. And then the market crashed right around the same time. It wasn't zero, maybe it was like 2% or something. But anyway, the point is it didn't lowering rates doesn't cause the crash. Raising rates causes a slowdown of the economy, which our economy is designed to crash. It's not designed to slow down. Like other countries, it slows down. In our country, it doesn't really, because our system is so set up that way. And it's a different episode. But basically, it would cause a crash. And then we say, oh, we got to bail them out, so let's lower rates. Well, they lower rates after they've already seen the signs. So the lowering of the rates doesn't cause the economy to crash. Raising rates causes it to crash. Lowering rates, it tries to ease it, but lowering rates doesn't affect it right away. It takes time, right? So if you look at 2008, they lowered rates pretty quickly, but it still kept crashing, right, until early 2009. Eventually, it came back because they were doing other things. Look at many instances of this. It's just not how it works, right? So just understand that charts like this you're going to see all the time, and it's saying, oh, look at this it's a correlation, not a causation. So don't draw a conclusion to it. And it says 2023 Fed pivots. Obviously this is earlier than that, but obviously they're not pivoting, and they said they're not for the next year. So does that mean we're not going to have a recession? I don't know, maybe we will, but I can be fairly confident, although I think this time's different, and I hate saying that word because it's always a bad sign. But if you think about what's going to happen if we go into a massive recession, is the Fed going to lower rates? Well, by history, I would say yes. I'm not so sure this time, but I still got this in the back of my mind. Like I got to prepare for them to lower rates, and if they do, it's all in chips on the, that kind of a thing, which people have been doing. But until then, and by the way, I'm not suggesting you go all in. Just saying it as an illustration. But basically, if they keep rates high, then it's going to just continue the demand destruction, as they call it, until a point when they need to lower rates to stimulate the economy again. Then the economy will pick back up and bounce again. So just be aware. I just thought this chart was really interesting and just wanted to share it with everybody. So, Doug, where can people find more about you?
Hey, muted. Sorry. Check us out at procollegeplanners.com. Download the updated numbers for the 2023-2024 school year, college funding, college planning. I know if you're out there with children, and if you're out there with children that are going to be going to college, and especially if you've got children in high school, you can't afford not to have this information. I know you have worries about the cost because you're like everybody else we talk to. I know you think that college has gotten too expensive. I know you want your child to be happy. I know you want them to have a degree that's going to be valuable and walk off stage on Friday into a job on Monday. Listen, don't do this alone. I mean, what does the debt clock say, Kirk? There's over a trillion, almost $1 trillion, if not over $1 trillion in college debt out there. You mentioned you can get rid of it through bankruptcy. I assure you it's not easy. A lot of families are facing this. Heck, if you've got the money to pay for college, do you really want to just give your money away and have them fleece you, or do you want to find a better way to pay? Start now. Find out some information. If you have any questions, give us a call or email us at info@procollegeplanners.com.
Great. Well, Doug, appreciate you coming on the show once again. That's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle, or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.